I'll get started and ask everyone to introduce themselves. Start with yourself.
Thank you very much, Thamim. My name is Chen Arad. I'm the Chief Operating Officer of Solidus Labs. We're based in New York, and we provide crypto-native market surveillance. We work with exchanges, brokerages, and increasingly so regulators to monitor, detect, investigate, and report market manipulation in digital asset markets. And I'd love to elaborate more later.
Hi, I'm Andrew Robinson. I look after the institutional business in EMEA for Coinbase from a product perspective that includes our exchange, our OTC desk, our custody business, and our prime brokerage business.
My name is Zarya. I'm founder and CEO of Bequant. We started as an exchange, expanded into the custody, and now launching a prime brokerage service for institutional community.
Good afternoon, everyone. My name is Markus Infanger. I run institutional markets in EMEA for Ripple. I joined Ripple around a year ago and previously was in the banking industry running several FX institutional sales departments.
Lovely. Let's get started off with Andrew. First of all, just been around this space for a little while, and so have Coinbase, probably the golden company of this crypto age. Do you mind giving us a quick overview of how exchanges have evolved from over the past 5 to 8 years, and what it's looking like over the next 5 years from your lens?
Yeah, I think that if you look back, call it 3 or 5 years ago, the exchange space was very much. It was like you would send money, kind of going even back further than that via Western Union or a wiring service, and you would hope that eventually in 48, 72 hours, it would show up in your exchange account. The funds would then be matched, and you'll be able to trade and then buy assets and take custody of those assets. I think that where we've evolved to since then is a bit more sophisticated in terms of the fiat on and off ramps, for starters. Outside of that, I think that the shift from retail to institutional flow has also changed. So, it was very much, Bitcoin started as a grassroots movement, right? A very libertarian movement where it was 100% retail. And now there's definitely more institutional players in the space. I think that we'll discuss at some point on this panel kind of what that means and what it looks like today. But more importantly, exchanges are now legitimate, regulated, compliant venues for efficient price discovery. So I think that we've really come a long way just chatting in terms of the work that you guys are doing with market surveillance and kind of having that third-party independent look at kind of the trading activity that's happening on a lot of these different venues. So from that perspective, we've taken big strides. I think looking out the next 3 to 5 years, if you look at our exchange, for example, Coinbase Pro versus the New York Stock Exchange, there's still a lot more improvement to be made in terms of just more sophisticated order types. Actually, are we going to bifurcate the market to a more institutional-only marketplace versus this kind of in-between between the institutional space and kind of a retail prime brokerage model that we have today? Will we kind of separate out the prime brokerage and the custody from the exchange? So I think that these are questions that are to be asked and to be determined, and I'm sure that everyone on the stage probably has a different view.
Thank you. George, a much younger sort of company in this space. What are your thoughts on that, and are your
very much aligned with Andrew. I mean, just 2 years ago, it's been a completely different market. I remember how we originated sort of our business model was out of the need to service institutional clients. When the 2017 peak happened, basically you would send a support ticket and you wait for a week or two, and regardless of whether you're trading, $100 or you're trading $100 million, everybody was pretty much equal. Everybody was in the cloud. There's no phone numbers. There's no contacts. So it was a complete Wild West. So now things are so much more efficient in terms of the communication. All exchanges have the institutional desks that support clients to the granular level. The technology has evolved massively in terms of looking at what's your uprate in terms of the exchange engine availability to do microseconds in latency and availability of collocation services and so on and so forth. So yeah, it's been a huge progress, and I think we're still there. I mean, the pace is still there in terms of development and exceeding expectations, really.
Yeah, perfect. Chen, from your perspective, when we look at you sort of mentioned the Wild West back in 2017, there was a lack of surveillance in in the community, and it's still quite a dirty word, may I say, from the crypto perspective. What are your thoughts on the surveillance aspect of how surveillance is helping to create more maturity in this space?
So I usually like to be a contrarian, but I am very much aligned with my colleagues here. I think it's one way of thinking about it is that 2 years ago, the CEO of Kraken, openly said crypto traders don't care about market manipulation. Today, our story is that we're a bunch of former Goldman equity trading guys. It was clear to us compliance is going to be a challenge, and we started walking into conferences, crypto conferences in 2017, and mentioning market surveillance. We got a lot of raised eyebrows. Like you said, it used to be, I wouldn't say a dirty word, just people didn't even know what it is in the context of crypto. Today, about 2 years later, we're sitting here at a crypto conference, and the head of institutional growth for Binance says on stage, market surveillance is extremely important. I think that clarifies how clear it is becoming that surveillance is critical for this market, but also in general, compliance. No one doubts, definitely here, but I think in general that crypto is here to stay. The question is, how is it going to grow? And I think most people here agree. It's kind of the fun thing about speaking at the last panel, because you can summarize whether, you can purport to summarize whether the other people like it or not. I think most people here would agree that one of the keys for growth is integrity, and one of the keys for integrity is compliance. And the way we look at it, compliance means growth, and there's a very clear reckoning that's also pushed not just by an understanding of the industry, but also by much clearer regulatory regimes. For example, in Hong Kong is one of the best examples that literally require market surveillance in order to apply for a license.
Brilliant, thank you. Markus, you've got quite a long-standing sort of institutional background, and you've recently sort of shifted into this space. From your perspective, what have been some of the largest changes in this space, or what, in your opinion, made you sort of make that jump from that world and think this is sort of your space?
Through looking at this through the lens of Ripple, I would say it's the fact that digital assets have moved from something that was, rather abstract and even somewhat anarchic to something that's very real and commercial. I can give you an example. MoneyGram, which is one of the largest payment service providers in the world, they're sending today 10% of their payments from the US to Mexico using our on-demand liquidity solution, which is supported by blockchain technology, digital asset exchanges, and leveraging XRP as a digital asset in the middle. If you think about this, 5 years ago or so, the crypto world was going through the litigations of the Silk Road, and here we are today, one of the fully regulated large financial institutions sending payments using XRP, allowing a worker in the US to basically instantly, sending money to his grandma for a fraction of the cost.
Perfect. Maybe you can dig a bit deeper on that. Chen, from your perspective, what have been some of the key components of sort of the market infrastructure from going from retail usage or having more applications for retail users to becoming an institutional player?
Well, first of all, I think that everyone understands that one of the best paths for growth is making institutions, and of course the significant amounts of money that they bring, feel comfortable with this ecosystem. That's really the driver. Combined, that comes from the market, right? That just ultimately wants to grow. Combined with also, it took a while, and it's probably going to take an additional while, but regulators, are starting to grasp this ecosystem, even in places that seem very, very slow, like the United States. And it's becoming very, very clear when you have some of the biggest actors in the space that have to restructure their operations in the United States, close and reopen because of fear of regulation. It's very clear that people understand that in order to continue growing, you have to be compliant and you have to provide institutional-grade infrastructure. It's a combination of those and as well as many other factors.
Okay, thank you. Andrew, we've seen Coinbase sort of evolve. I question whether it's still an exchange or not. And from your perspective, what is still missing? Why haven't the large pension funds of this world with 10 billion or tens of billions of dollars in assets not deployed in the hundreds of millions in the space? And we're seeing Coinbase sort of introducing several different sort of product streams. What's missing
Yeah, I would say that like we're definitely not just an exchange, right? We're a collection of digital asset businesses, and like that's what we strive to be. And I think that right now, and kind of where we are within the development of the space, it necessitates kind of being involved in those different business units to make sure we're able to meet our institutional customers where they are. In terms of what holds back the true pension funds, endowments, and the larger asset allocators to come into this space, I mean, there's three main things I always say. One is the lack of regulatory clarity that we have from like regulations and kind of clear enforcement of rules and laws going forward. Two is the lack of availability for realistic and kind of reliable market infrastructure and market structure, which a lot of us are here addressing. And then the third thing is just the reputational risk that still overhangs the person that potentially adds Bitcoin to a portfolio and it goes missing, or the person that has Bitcoin put out on an offering memorandum and then it goes down 40% the next day, or whatever the negative headlines might be. It's just still too great of a risk to the core businesses of a lot of these asset managers for them to dip their toes in. With that being said, I think that if you look across the markets globally, the US is a lot more mature than the institutional market here in Europe, and the fact that we see some endowments that are active in the space. We count some of the larger university endowments amongst our custody clients, for instance. So they are active, and some are choosing to be silently active in the space.
Okay.
Whereas in Europe, I think we're probably still anywhere from 2 to 5 years away before we see some of the traditional asset allocators kind of start to move into the space.
Markus, if I may ask, so the second challenge you sort of mentioned, Andrew, was around sort of market infrastructure sort of challenges. Global FX sees something like $6.3 trillion being traded every day. London sees almost half of that. From your perspective, can you dig a bit deeper in terms of what's missing from a market infrastructure level? What do we need to evolve this a bit further?
So I broadly agree, with the points already highlighted by Andrew. I think, if you narrow it down to one thing that's missing, it's probably time, because the broader elements are in place. And also, I think the absolutely critical thing that needs to further unfold is utility creation, right? If these cryptocurrencies or digital assets are to become more valuable, society as a whole needs to feel that it actually helps them, to go about their lives better, solve real problems. So I think that's the ultimate driver. So utility is kind of, the main driver for adoption. And, obviously we had this big hype in 2017 where basically you can say, these digital assets on a broader scale came to real, kind of visible value. And now we're still in a phase, I feel, where reality is sort of catching up with that hype, and we need to just see more of this utility to develop, right? And obviously infrastructure to fall in place. You look around and you can really find actually very good institutional infrastructure around digital asset, and Coinbase is a great example. But it's something you need to actively look for as an institutional player who wants to allocate capital, and it's not omnipresent and not very intuitive and easy. I think these are, so I would narrow it down to time, as said, and utility creation as a predominant sort of factor.
Can I push you dare to say by time? What are you in your sort of assumption? What are some of the horizons? Maybe you can open up to the whole panel. How far? So how much more time do we need?
I guess I'll turn a question in terms of, again, how are we defining institution?
Yeah.
Right? Because, if you're talking like high net worth individuals and family and multifamily offices, they're here. They're here kind of in a real way already. Yeah. But again, if you're talking about global macro hedge funds and then kind of large quant hedge funds and then from there the actual asset allocators, I would say kind of in that order, we're probably about another year out from like seeing like macro hedge funds coming into space, again, from a European perspective. And then from a traditional asset allocator, I would say 3 to 5 years probably, in a meaningful way.
It definitely feels more real, the institutional money coming in.
Yes.
Every year we meet at the conferences, and the level and the granularity of topics we cover is completely different. So there's clearly a huge evolutionary process that's happening, and we have more conversations with the larger institutions, and we're seeing the very genuine interest in coming into this space, and their expertise is growing. It's not just the playing with funny money.
Yeah.
It's real asset class, and
Yeah.
that's what it's.
George, if I'm not mistaken, I'll come back to that. Sort of you focus on sort of some of the more institutional clients in the space, as well as everyone else. Who are some of these sort of marketplace clients from your perspective?
Well, the first entrance to the market were the proprietary trading groups that are using algorithms. The guys that have been, in the pretty much every part of the world, in every liquidity pool, making markets, making money off of inefficiencies, arbitrage, HFT strategies, and so on. So the crypto has been one of these emerging markets for them that was easy entrance and provided a lot of inefficiencies for them to capitalize on. So that segment has very solidly settled. But I mean, what we don't see yet is the long-only funds, is more traditional financial institutions like pension funds and so on coming in. So that traction has been pretty slow so far. And obviously the retail segment, which is it's here and it's not here, and it really depends on the hype and the price of Bitcoin.
Yeah.
So, but again, I think there's one more segment that worth covering is the actual institutions that invest into infrastructure. So it's not just about trading Bitcoin; it's about adopting blockchain technologies, like using Ripple, for example, to facilitate money transfer, using blockchain to settle and clear, and do so many other things.
Brilliant. Chen, would you like to add anything to that?
Well,
what does compliance play into this?
Well, first of all, I just wanted to support Andrew's point about endowment funds in the US with some data. There was a study that was done. It was almost a year ago, so the numbers must be even bigger now. It surveyed 150 endowment funds in Canada, the United States, and the UK, and more than 95% were already invested in crypto in some way, and a large proportion of them said they're going to increase their ratio. So that is the biggest, if you ask me, the biggest demonstration of interest in the space from some of the most institutional players. I started on a very optimistic note that there's a recognition that instruments like surveillance are critical, and of course that's critical from an institutional perspective, but it's also important to remember the challenges. If you look, for example, at Crypto Compare's benchmarking report, the most recent one was released, I believe, last month. Of the more or less 160 exchanges that are ranked by Crypto Compare, under 10% self-report to have a surveillance system. And many of those surveillance systems are internally developed. And I think it's a very important question to understand why, on the one hand, there is a recognition that this is critical, and on the other hand, it's not yet being implemented. And I think, first of all, it's because there is a big focus when it comes to compliance on the origination of funds. And that makes sense. People want to understand, know that they have a grasp of where is the money coming from, and there are a lot of great companies doing work in that regard, and a lot of new forms of regulation, from the FATF guidelines and travel rule to local regulations. However, and we know this because we have conversations with surveillance about market surveillance and compliance with our clients and prospects all the time. Part of the challenge is that it's very hard to set up and maintain a cost-efficient compliance operation when you're trading crypto. And of course, we believe that a part of it is because there's a need for tailored tools. Adaptation can cost a lot, can result in a lot of false positives that result in more overhead, and of course that's how we and many other companies are trying to help in that regard by creating crypto-native tools. And the other part of this is crypto-native rules or standards. George is involved as well with a committee that I co-chair with Global Digital Finance, to create a code of conduct for market integrity that will soon go out for regulatory consultations. And I think that's another really important piece in order to encourage and enable companies that are increasingly interested in being compliant and being transparent with tools that just make it cost efficient for them.
Brilliant. Andrew, would you mind sharing, what do you see some of your institutional clients doing in the space?
When you say doing, I guess to clarify exactly, you mean from a trading perspective, or?
It's not very clear. Are institutional clients just holding crypto assets, or Well, what are they actually doing with this sort of asset classes?
Yeah, again, I think it comes back down to the client segment, right? So to Marcus's point and to George's point, you have the market makers who are obviously very active. They have the algos in place, and they're sitting there providing liquidity the same way they would on any other exchange or venue where financial assets are traded. And then you have so that's kind of one end of the spectrum in terms of very active traders. And then on the other end of the spectrum, you have the endowments and the VC funds who are, in the endowment's case, mostly holding Bitcoin and long-term kind of dollar cost averaging down. And then you have the VCs who have participated in a lot of the various SAFs over the years who are holding the assets, again, from a 7 to 10-year view. They want to have them locked away in custody, but they also want to have network participation, right? So they want to be able to stake Tezos. They want to be able to vote with governance and Maker. So I think it kind of depends on that client segment. To the point, I think the gap that we're still missing from a active investor perspective is kind of the directional long-only funds that are kind of trading in and out on a 3 to 4 months basis. We haven't seen much of that, so I would say it's more kind of the prop, active hedge fund, market neutral strategies to the longer-term VCs, endowment style investing.
An open question maybe to the whole panel here. So market makers are very rapidly making this space extremely efficient. Is there still money to be made in this in this space?
Sorry,
from your perspective, like, so saying the market makers are making the markets extremely efficient as they should be, and liquidity isn't necessarily always available. How would you address that, or where do we need to think a bit more creatively?
Yeah, I think that from that perspective, to answer your first question in terms of is there still money to be made in the space, I think so. I think that even yesterday, I know so. If you looked at what happened yesterday with the massive risk-off move down on all asset classes, but obviously digital assets were kind of hit due to the high beta, was that you saw, again, the arb on exchanges between ourselves and some of our other competitors, like on the Euro BTC crosses. So I think that there's definitely still money to be made. However, it's getting harder and harder the more that we have these professional Chicago HFT firms come in. It's becoming harder and harder to compete with them. So now, you and I setting up an algo in our bid room, and we're competing against someone that has a lot of technology based in Chicago with a lot of money, it's going to become harder for us to gain that competitive edge. So I think the easy money that was there in 2017 and 2018 from point and clicking ARB is, I shouldn't say definitely gone, but has become harder to come by. And then in terms of what do we need to do to improve the liquidity, is that if you look across kind of the digital asset space, there's so many exchanges. I don't even know the number, but there must be in the hundreds. And from the vantage point that I have is that I see a lot of the exchanges that are coming online because they're also trying to open up accounts with us to source liquidity. And I don't know, I get 2 to 3 applications a day that come through from a new exchange starting up somewhere in the world. And to me, that just continues to fragment the market and the liquidity and further dislocates it. So I think that over the next, call it 12 to 18 months, we'll probably see consolidation, if anything, in the space as fees start to compress, trend towards not necessarily zero, but to lower levels, and it becomes harder to make money by just spinning up an exchange and having 1,000 clients on it.
If I may add to that, from our perspective as a prime broker, that's what part of the issue that we're trying to solve is the entrance to the market. So ease that entrance in terms of the accessibility to the multiple exchanges. So we remove the need to go into each platform and get set up and so on and so forth. And combine the liquidity. So liquidity is pretty thin. So for a large institutional to come in and invest 100 million, it's becoming difficult. So the sourcing of that liquidity, so consolidation of volumes essentially, is what we're going to be seeing going forward. And there's been already a sort of a counter trend. So there's been a trend of the new exchanging popping out, but then there's a counter trend when larger participants offering white label solutions. So you're trying to extend your liquidity into new platforms and the new brands, but keeping it all within the one liquidity pool. So these kind of things are telling us that the market is becoming more efficient for sure.
Would you like to add any to that, Markus?
No, I think that's pretty well summed up.
Okay.
Their area of expertise anyways.
That's it. Chen, so come back to the technology behind the exchanges. Do you think we're leading to sort of concentration or centralization, if I can call it that?
Well, I think at the moment, the vast majority of crypto trading volume is centralized. We had that conversation earlier. I think that at the end of the day, even though everyone appreciates the merit of decentralization, or at least a lot of this industry specifically appreciates the merits of decentralization and democratization, there's a reason that people don't usually vote for libertarian governments, right? I mean, the majority of people want to operate and invest in a space that is regulated and has some, and there are some guarantees that someone is watching over their back. And as I think we all agreed, I mean, that's a big part of the growth of this space. I think it's going to be very interesting to see how decentralized exchanges continue to evolve and how much they're able to provide an alternative. But from our perspective, at the moment, this is the way the market operates, and it can grow a lot while still while the majority of trading is still happening in a centralized manner.
Markus, what thoughts on this sort of concentration of?
Right. So I think in an asset class that is so infant and moving so fast, it's absolutely natural to see a consolidation happening. And make no mistakes, there is plenty of very large market players still waiting on the sidelines, and they're ready to go. Once the opportunity size reaches a certain threshold, they're ready to go. So I'm not so worried about this notion of concentration. I think at the same time, the element of contestability is critical, right? As a guiding principle for a liquid market to thrive and evolve. So contestability is important and one of the fundamentals. Look at the FX market, which is the largest market in the world. Nobody has a lot higher market share than 10%. So I guess that's an important factor. But given this market has so much growth opportunity and is in such an early stage still, digital assets as a whole, I don't think it's something to be critically worried about right now.
Let's move on to some of the regulatory aspects of this discussion. I know Andrew, Coinbase spent a lot of money on the R&D aspects of this, but so on the regulatory sort of aspects, it's very important. But how do you sort of balance operational cost on sort of spending on regulation versus R&D in this space?
I mean, for us, we think that regulation is like a USP for us, right? So we kind of don't think about do we invest in R&D or do we invest in regulation? Regulation is always going to get the investment. It's something that we welcome to the space. It's something that we want more in the space because we think that it's ultimately going to foster that innovation, mainstream adoption of crypto, and actually lead to the institutional money coming into the market. So I think if anything, I would say as a firm, we've been kind of frustrated at the slowness of certain governments in certain regions to kind of give us more clarity from a regulatory perspective. And we're getting there, at least from a European perspective, right? You have Switzerland now with rules, you have Germany, you have the Netherlands and France coming out with kind of their own set of regulations. Not the most efficient way when you kind of think about scaling up a business and you have to go open up entities in each of these countries, or you have to go have extra local staff in each of these countries. It becomes more kind of an operational footprint that's a disaster from accounting and tax perspective, but something that we think is needed to drive the space in the right direction. So for us, it's not really a trade-off of versus regulatory spend versus R&D spend. It's kind of just making sure that we have our hands in both pots.
Okay, brilliant. George, you're based in Malta, right? What are your thoughts on the sort of regulation in the space and why Malta?
When we sort of launched the business and looked into the whole regulatory landscape, it was still a pretty shallow market in terms of the jurisdictions that have the regulatory framework. When we looked into Europe, it was Malta, it was Gibraltar, and there was something cooking in Switzerland as well. So when we were sort of riding the wave of the popularity of the Maltese framework, so we jumped on that bandwagon. Now we're seeing the regulatory regimes are being introduced across Europe, and I hope that at some point we're going to have a unified sort of a MiFID-like regulation for Europe to sort of remove all these discrepancies between different countries and different regulations. But very much looking forward for the UK regulation to evolve from the existing level. So again we're very much welcoming the process, but it's from the the cost perspective, as you mentioned. it is becoming, you know, it feels. We start to feeling the pain now with the amounts of efforts we have to put into the regulation. And I come from the regulated business, and I remember as a CEO of the FCA regulated company, I used to spend 40% of my time just doing the compliance stuff, and only 60, you know, business related issues. I mean, this ratio is still not there, but I feel like we're moving towards that direction.
Yeah, finally, before we get into Q&A, Chen, from your perspective, you've got sort of warming relationships with the SEC over in the States. How have their sort of perspective evolved, or has it evolved in sort of in this domain?
Well, I think your question about the balance between R&D and regulatory is very interesting. Obviously, our perspective is a little different because they're completely intermingled. When you develop a RegTalk solution, obviously regulatory input is a part of that, and it kind of becomes a very mixed process. So generally speaking, so it's interesting, right? Because I remember I was here a year ago and I said that regulators in the US are not, it's not that they're tying their shoes, they're still looking for their shoes. And in some ways it is behind. At the same time, one thing we've really grown to understand is that, again, if you look at the Crypto Compare benchmarking report, some of the leading exchanges there in terms of the credibility of data, the credibility of volume, come from the United States. And that has to do with the fact that people there are afraid of the regulators. You can't argue with that. So in that sense, the slowness of their progress promotes integrity. I know that, I mean, we know from our internal conversations, not just with the SEC, with regulators in general, in the States and also in other places, but I mean, specifically in the States, there's a lot of concern that the US is falling behind. There's more and more looking at it from a geopolitical perspective and trying to understand what China is doing and how is it going to affect the North. So there's a haste. People are in a haste. I think one of the biggest challenges is and that's probably one of the most interesting fundamental difference between this asset class and traditional assets, it's the cross-market, cross-asset question. The reason the SEC repeatedly rejects ETF applications is that they're concerned about the underlying market. And you know, even though individual exchanges implementing surveillance would do a great deal for this space in terms of market integrity, the question of shared surveillance and how can we really surveil a market where the same assets are traded across a lot of different exchanges that has a lot of different standards, how can we really surveil it and understand what's going in there? That's one of the questions that interests them the most, in addition to the custody question. And I know there are very interesting initiatives. Some of them we're involved with to try and resolve it. And I think that together, the industry and regulators we're gonna be seeing a lot of progress very soon.
Brilliant, thank you. Let's just take one or two sort of questions here. Let's start with Coinbase has going through acquisition. Bequant has multiple lines of business. Do crypto businesses need to diversify and grow? And maybe I can add one bit to that. What sort of asset classes do you see being introduced in the near future?
What other asset classes?
Yeah.
Do you need to diversify to grow? I feel as though that's like a part strategic, part philosophical question that you can debate. I guess at some point businesses you need to offer a new revenue stream to grow. Like, do you have to acquire someone? I don't know, but you have to do something kind of additional to generate the incremental dollar, right? That's just like the way that it kind of works from a mathematical perspective. I think that like probably why we have seen crypto businesses diversify is that obviously exchange revenue is very lumpy, it's very cyclical. So by adding in different business lines, you increase your low market dependency revenue, right? So it's just a good way from like a investor perspective, like way to manage your cash flows and your operational expenses. It's just easier and simpler. In terms of different assets being added, I guess the big hype is security tokens, and I think that again we're going to get there. It's a matter of kind of when, not if.
The synergy plays a huge role in extending the product lines and businesses, because you might be good in retail, right? So as you add the institutional, it creates this multiplier effect which you know saves on cost, improves your margins and so on. So and having the several foots in different doors also helps, because the market is young, and if you look into 5 years from now, we're going to be in a different world. Having a small market share in each of these business lines and segments also makes a perfect sense.
I'll just mention briefly in that regard that, I mean, I agree. One thing to be mindful of in terms of potential market abuse and market integrity concerns when you talk about diversification of the same businesses is the question of conflicts of interest, which we should be very mindful of. And I know that there are a lot of actors that do it responsibly, but just something to think about.
Avi, unfortunately, we've run out of time there. So ladies and gentlemen, thank you very much. Just a warm round of claps for the panel.